Well, welcome and thank you everybody for joining us today on farm loans with the FSA office and also the Bank of North Dakota. I'm Amanda McLean, the farm management specialist here with North Dakota Farmers Union, and I will be your moderator for this webinar. This is the first of our series Beyond the Farm, where we will be talking about different topics once a month. These webinars are the third Thursday of every month at 10 a.m. So please join us for the next coming webinars. Next month will be also with the state FSA office talking ARC and PLC enrollment. With that, I'd like to introduce our speakers today, Lisa Meny, who is a farm loan specialist with North Dakota FSA office. Also, Holly Highmark, who is also a farm loan specialist with North Dakota State FSA office, and Jim Lear, who is an agribusiness banker with the Bank of North Dakota. Just a few housekeeping tips before we get started. This webinar is being recorded, so everyone is on mute just to vent background noises. But if at any time you have any questions, feel free to type them into the chat or the Q&A, and we will make sure that our guest speakers will answer those. Also, we will have time for Q&A at the end of the presentation, so if you want to hold off, but at any time, feel free to answer a question. And as I said, this webinar is being recorded, and if you would like to rewatch it or share it with anybody, it will be on the North Dakota YouTube channel, so you can easily go to Google and find YouTube and type in North Dakota Farmers Union, and you should be able to find the farm loan webinar today. So with that, I will turn it over to you, Holly.
See if we can get this. All right. Good morning, everybody. I am Holly Highmark. I work with the Guaranteed Farm Loan Program at the North Dakota State FSA office. I'm going to visit with you today about the Guaranteed Loan Program. It is a federal program that's administered by USDA's Farm Service Agency. This program authorizes FSA to give banks a guarantee of repayment on a commercial loan up to 95% of any loss of principal interest, including some miscellaneous liquidation expenses if it were to come to that. North Dakota has 19 offices that administer the guaranteed loan program, along with the direct loan program that you're going to hear about later. Here is a map. On this map, the offices that have farm loan program presence within the county office are indicated with a white marker. Could be a circle or a diamond. Those are the offices that you want to work with when you're applying for a guaranteed loan. If you happen to be in a county office where there is no white marker, you're going to work with the one that's closest to you or the one where the borrower or producer's farm operation is located. Most lenders know where their closest FLP office is located.
Holly, do you want to change your screen? I don't know if you wanted, it's not full. Sorry to interrupt you.
Not full. Thank you. Let's try it again. Is that better?
Not
You
see
don't
yours.
see any screen. If you can reshare and then put it in the presenter mode. It was just showing the full PowerPoint screen.
See.
We can see your
I
screen. I just
apologize.
can't see your presentation. Well, I think while we get through the
I'm sorry.
technology, I'm going to do a poll. And I just kind of like to know, for those of you who are joining us today, this is completely anonymous, but just to get a better view of our crowd, if you could please take the poll on what role you're attending today. If you are a lender who works in anything with financing or banking, or you're an operator such as a farmer or rancher, or if you're joining us together as both, or if you're some type of other agribusiness education, please feel free to take answer our poll while we get these technologies figured out. So, and Holly, it's fine if you can't get it to work. We'll just do it in the other presenter mode. Well, I'm going to end the poll now. Looks like most people have responded. And that's good. We have about 50% of farmers and ranchers, and that's definitely the crowd we want to make sure that we're addressing along with the lenders who are there to help you. So appreciate you guys for taking that short survey.
Okay, I'll try it again. I apologize. Here. How's that?
Awesome. Correct. Thank
Oh,
you.
I apologize for that.
Nope,
So,
it's happens. Thank you, Holly.
okay. Yep. I'm gonna start back on the map here, just in case you didn't get to see that. As I said, the FLP offices are located in any place that has a white marker, whether it's a diamond or a circle there. So you want to apply in the office closest to you. What is a guaranteed loan? It's a loan or a line of credit made and serviced by a lender for which the agency has entered into a lender's agreement and which the agency has issued a loan guarantee. Couple of reasons why both the lender and the borrower can benefit from the use of the guaranteed loan program. The benefits to both are essentially the same. One is for risk mitigation. It allows the lenders to make loans that don't meet their typical underwriting standards, and it allows the borrower to maintain their working relationship with their bank. This is typically during times of low prices or low yields, when cash flow margins are tight, or where there's lower security margins for the borrower. In addition to that risk mitigation, it also allows lenders to access the secondary market. USDA loan guarantee is typically a requirement for a lender to sell a loan on the secondary market with BND or Farmer Mac, for instance. And it just allows that lender more flexibility with their rates and terms, and potentially with their own lending limit. So those are the primary benefits. How does a guaranteed program work? Essentially, the borrower or the producer is just going to go to their bank and apply for a loan like they normally would. And if it is a year with a tighter cash flow plan and the request does not meet the bank's lender underwriting requirements, then the bank will request to FSA or apply to FSA for that loan guarantee. There really isn't anything that the borrower needs to request from FSA, or that they need to ask their borrower, or ask their lender to do. Typically, the lender is going to ask for that on their own, and then they just work with their lender as usual. Limits for a guaranteed loan program. USDA can guarantee loans up to an amount of $2,251,000 per operation. And this limit is combined for farm ownership and operating type loans or lines of credit, and that's a maximum aggregate limit for both direct and guaranteed loans. This is the most common limit that is reached for our borrowers. There are some additional limits when you start including some non-typical type loans or combined assistance types. For instance, a land contract or a conservation loan or an emergency type loan. There's higher limits available if some of those are also used or utilized by the borrower. Fees, there's just one fee associated with a guaranteed loan, and that is 1.5% of the guaranteed loan amount times the guarantee percentage. And this fee is typically paid by the lenders to FSA, but they turn around and typically pass that on to the borrower. It can, on those larger loan amounts, that fee can add up, and if it's not available in the cash flow plan, it can be included in the loan request amount. There are instances where there's a waiver of that fee for beginning farmers, socially disadvantaged, or veteran farmers. When they have a balance on a state beginning farmer real estate loan, typically those are either from FSA or from BND. So they either have an existing loan of that type or they're going to have one at the time of closing. Then that fee can be waived. Or the other option for waiving that fee is when the majority of the new guaranteed loan funds are going to be used to refinance FSA direct loans. FSA's goal with the direct loan program is to eventually get our borrowers back into the banks. So by waiving that fee, it gives the lender an incentive to take on some riskier operations or beginning farmers or any type of operation that might be at more risk. And by waiving that fee, they can still get a guarantee on the new borrower. So it's a benefit to both. The amount of the loan that can be guaranteed most commonly is 90%. That's our standard guarantee. We can give 95% guarantees for beginning farmers or socially disadvantaged borrowers. This is a benefit for the lender to get a higher guarantee, but it also could result in a higher fee for the borrower. So it just depends. Unless they have one of those beginning farmer down payment or state beginning farmer loans, then they are eligible for that waiver again. And typically we don't go below that 90% guarantee unless there is limited security or tight or questionable cash flows. We can reduce the amount if we're still willing to give the guarantee on that loan. This is just a brief comment. The guaranteed loan program does have targeted producers for beginning farmers, socially disadvantaged applicants, or veteran farmers. Essentially, all that means is there's a separate pot of targeted funds for those producers. However, the guaranteed loan program is available to anybody meeting the specific eligibility requirements and who the lender feels qualifies as a risk. The different loan types here now, which is what I think everybody wants to know about today. Your typical line of credit or annual operating loan. For a annual operating loan, FSA can provide a 5-year line of credit for 5 production years, and then that final year can have an additional 2 years to repay based on marketing requirements. That loan can be used to pay annual operating expenses, provide family living, or purchase feeder animals, payment of scheduled non-delinquent term debt payments, as long as they were used for authorized FO or OL purposes. And then with that, along with that line of credit, if it's indicated as a 5-year line of credit, each production year must be reconciled with an annual analysis prior to advancing on the next year. So we just want to know each year that the line of credit if it was maxed, that there's inventory on hand to get that all paid in full prior to advancing for the next year. If not, and there's a shortage, then we would want to see the loan serviced in some way to term it out, and then reapply for a line of credit as needed. Term operating loans for purchases of machinery and equipment, breeding livestock, or fixtures on the farm. Those loans can be for a maximum of 7 years to start. The lender can utilize some longer amortization periods as they allow within their bank's rules. Can also use those costs to reorganize a farm and to improve profitability or purchase entity shares. You can do some smaller limited real estate improvements with those loans or refinance existing OL debt that is out there. The terms of those loans will be determined by the lender and are based on collateral, wear and tear, depreciation, those kinds of things, but typically they can go out to 7 years. Can also be used for beet stock purchases. Another type of loan that's available or eligible for an FSA guarantee would be a farm ownership loan. The maximum term for this is 40 years. This is going to be determined by the lender and what their regulations are for how long they can go out for a term, but FSA will allow up to 40 years, and that can be used for real estate purchases or real estate improvements, or to refinance indebtedness incurred for authorized farm ownership or operating loan purposes. Any type of farm ownership loan with the longer term is going to require that real estate security. And then along with farm ownership type loans, FSA allows joint financing arrangements. These are utilized pretty commonly between FSA and BND. I'm sorry, between FSA and a lender. It's where two or more lenders make separate loans simultaneously to provide all of the funds required by one applicant. So for those larger real estate purchases, or when the lower rates and terms of one lender can contribute to a feasible cash flow plan for the applicant. For instance, if it's sold on the secondary market, they can get some lower rates and terms, and then the lender will provide a portion, and then the secondary market lender can provide some better rates and terms, all contributing to a better cash flow plan. And FSA has those, like I mentioned, direct loan options that work for joint financing as well. And within that joint financing arrangement, the lender can also apply for a guarantee on their portion. So not only are they not supplying all of the funds, but their applicant gets the benefit of the best rates and terms available, but the lender can also get that guarantee to mitigate any risk that they might have. And then lastly, the conservation loan is the least common loan type that typically requests a guarantee. I believe this is also available for direct loan options. And again, it's just not utilized very regularly. That can be used to install structures to address soil, water, and related resources conservation, establish forest cover for sustainable yield timber management, install waste management systems, etc. I think NRCS and soil and water conservation a lot of times has grants or financing options available through their organization. So typically this one is the least commonly used loan option. In addition to our loan types, there are loan servicing options. And from what we're hearing about cash flows this year due to lower prices and a lot of drought, there could be a need for some servicing options for loans. Any guaranteed loan is going to be serviced according to the lender's criteria, but FSA allows for rescheduling of debt, deferrals, and write-downs. And we're always going to start with the least harmful servicing option, which is primarily going to be rescheduling of debt. It's the most common. We're going to stretch out, the lender has the option to stretch out the term of their existing farm ownership, operating loans, or lines of credit if there's a shortfall. That interest rate can be negotiated between the lender and the borrower. Interest may or may not be capitalized. Anytime a loan is restructured and you're capitalizing the interest, we just have to ensure that the aggregate guaranteed loan amount in combination with the direct loan amount stays within those statutory limits that we talked about earlier. And at this time, loan consolidation may also be allowed under certain circumstances. We're expecting a lot of potential requests for restructuring from lenders this winter to term out some shortfalls on line of credits. And anytime servicing options are completed on a loan, the loan guarantee remains with that loan. You don't need to reapply for it. Once the new note is completed or the allonge or credit agreement, it just gets attached to the original note and that loan guarantee will stay with it until it matures. Same thing with deferrals. It's just another option. It postpones the payment of principal and interest to accommodate a temporary shortfall for the borrower. There's regulations for each of these types, but they are available. And then worst comes to worst, we can allow the lender to do a write down. Like I said, the most common of these is rescheduling. Typically, prior to getting to a write down, the lenders will work with some type of liquidation or partial liquidation in order to bring that loan current. That is all I really have for guaranteed loan program. I believe we're going to take questions at the end. I'll turn it over. You're on mute.
We had one question come in. Will the PowerPoints be available? Yes. When we send out the recording to the webinar, we will also make sure that we attach these PowerPoints. So yes, that will be. All right. Well, I don't see any other questions coming in, so we'll turn it over to Lisa for now, and then we'll open up for Q&A again for specific questions to the state FSA office.
Perfect. All right. Can everybody hear me and see my screen okay?
Yep.
Okay, perfect. All right. Well, first of all, I want to thank Farmers Union and Amanda for inviting FSA to participate in this series of webinars. I believe that this is the third year that FSA has participated. And so we really appreciate being given the opportunity to do that and to be able to share our program information with both lenders and with farmers and ranchers. And the last time I looked, I think we had 115 people on this webinar. So it is so nice to be able to have such a mix of both farmers and ranchers and lenders and folks that are potentially interested in our programs. So today I am going to talk with you all about the direct loan programs that we have. And then I did add in some slides at the very end of my presentation that talk about some of the loan servicing options that are available to existing FSA borrowers. And we can talk about that, like I said, at the end. And then if there are any questions on potential things that could be done for folks that maybe aren't existing producers with FSA or borrowers, but that are maybe looking at a potential shortfall from 2024, we can talk about what options might be available. We certainly know that with the way commodity prices have been and the expenses that there are looking to be some shortfalls. And I don't want to start out my presentation with doom and gloom, but that is a fact and that's a reality. We know we've been getting a lot of calls in our county offices across the state. So first, let's just get into the options and the loans that FSA has, and then we certainly will entertain questions after that. So we will get started here. This slide is just to let you know about the real estate loan programs, farm ownership or FO loan programs that are available with FSA. And then, so this is just the summary slide, and then we'll go into each of the programs that we have here specifically. So the farm ownership loan programs at FSA, the maximum indebtedness or the maximum loan amount outstanding is 600,000, and that's cumulative. That's not per loan. So the maximum that any borrower could have on outstanding on real estate is 600,000, except for the beginning farmer down payment program, and we'll talk about that. The standard rate at FSA is 40 years. We have a fixed interest rate for the life of that loan. FSA does not have any prepayment penalties. And in most cases, other than the beginning farmer down payment program, FSA does not require a down payment. Some of the eligibility requirements for a real estate loan or an FO loan is that the applicant has to be the owner and the operator of the farm that's financed with the FSA agency funds after the loan is closed. Okay, so they have to be the owner and the operator. We are not in the business of making a real estate loan and then having that loan or that borrower rent out that land for investment type purposes. We are strictly making these real estate loans to producers that are going to be the ones farming and or ranching on that land. We also have quite a lengthy list of eligibility requirements. One of those being farm experience. If we're going to make a real estate loan and term that out for up to 40 years, we certainly want to make sure that the person that we're making this long-term real estate loan has farm experience, previous farm experience. And so in our rules and regulations, Congress has made some expansions to the eligibility requirements. We used to take a look and just simply state that we needed multiple years of what we call, the Schedule F, the income and expense in the tax records for farming. And now Congress has expanded some of our eligibility. So we need to see that the applicant has been participating in the business operations of a farm for at least 3 out of the last 10 years prior to the date that they submitted their application for the real estate loan. And then we are able to substitute some of those years with, say, college education, or if they've been a farm laborer and have substantial management responsibilities, if they've been honorably discharged from the armed forces, etc. I'm not going to go through the entire list here, but we certainly want to make sure that our applicants do have some farm experience. And like I said, the old days, we would just say, hey, you're not really eligible unless you have 3 years of a Schedule F. Well, we certainly don't say it that way anymore, but that is the easiest way to show that you have been farming and or ranching by submitting the taxes that show that you do have 3 years of a Schedule F. So we'll talk about the uses for our farm ownership programs. We can use those loan funds for a real estate loan to acquire or enlarge a farm, make a down payment on a farm, to make capital improvements, also to promote soil and water conservation and protection. We can use some of the loan funds to pay the closing costs, or in times when the Farm Service Agency does not have funding available, we could use our real estate loan to refinance a bridge loan. At this time, we do have adequate funding. And so the use of real estate loan funds to refinance a bridge loan is not acceptable. That is not to be done. And so since we have the funds, we can advance those loan funds directly to the attorney and the seller. We do not need to have other lenders involved with making what we call a bridge loan. The biggest thing to remember with the direct real estate loans is they cannot, and I stress the word not, cannot be used to refinance real estate debt. So remember with the real estate loans direct from FSA that these loan funds are literally used for two things, to build or to buy. Okay, no refinance included in FOs. All right, so one of the programs that we have is the Beginning Farmer Down Payment Program. And with this program, obviously, you need to be a beginning farmer or a socially disadvantaged or veteran farmer to be eligible for this one specific program. And that applicant or beginning farmer would make a 5% cash down payment that is required. That money cannot be borrowed. I would need to see that that 5% cash down payment is available on the balance sheet as a current asset under cash, or it could be, maybe some crop that's on hand or some market livestock. But once we get the application for that FO loan, we would need to see that that 5% cash down payment is available at that time. FSA would finance a maximum of 45% of the purchase price. And here's kind of where that caveat is when I talked about the $600,000 max loan indebtedness for the Beginning Farmer Down Payment Program. Congress has said that the maximum that can be borrowed there is 45% of the purchase price up to $667,000, which the 45% of that is $300,150. I didn't determine that percentage of that number. Again, that came from Congress. So the maximum that a borrower could have with the Beginning Farmer Down Payment Program, that loan amount would be $300,150. And then the remaining balance, 50%, would be financed by another lender, whether that's the local lender, a credit union, Bank of North Dakota, NDRRC, etc. The seller could also be the one to finance that remaining 50%. So with the program at FSA, the borrower would have a loan term of 20 years and the interest rate is fixed at 1.5%. The participating lender in this program would have to have a minimum 30-year amortization on their loan at their interest rate. And the nice thing for this program is that the lender that's participating also gets a first lien on the real estate. FSA would then file our mortgage after that first mortgage is filed, and we would have a second lien position. And the other nice thing is that if we have a participating lender, they could also apply for a guarantee on that portion of the real estate loan, like Holly just talked about. So we have a really nice way to shore up all of the financing that needs to be done, provide a nice low interest rate for the FSA producer, have a nice term with the participating lender, and that participating lender could also minimize their risk by applying for a guaranteed farm ownership loan. But again, remember, for eligibility on this program, you need to be a beginning farmer, be socially disadvantaged, or a veteran farmer. So let's talk about what those definitions are. For socially disadvantaged, or what we call traditionally underserved, those producers are folks that fall into specific racial groups as listed here. And that also now does include women to be socially disadvantaged. A veteran farmer, you can see the definition here, has served in multiple branches of the armed forces of the United States and haven't operated a farm, or they have been operating a farm, but for not more than 10 years. So that's a nice addition to some of our eligibility that came in the last few years for veteran farmers. And then for a beginning farmer, to be considered a beginning farmer, the producer would need to be farming for 10 years or less. And then for this specific beginning farmer down payment program, they do not own more than 30% of the average farm size for the county where their property is located. And that 30% is based on our most recent 2022 census of ag. And I've listed all the counties in North Dakota, what the average farm size is. and then what the 30% of the average farm size would be. So if we just take a look at Nelson County, average farm size is 1,215 acres. 30% of that average farm size is 364 and a half acres. So to be eligible for the beginning farmer down payment loan, though that producer would at that time need to own less than 364.5 acres. Another way that we can finance real estate is with our participation, or what we call our joint financing real estate program. In this case, FSA's portion of the loan can't exceed 50% of the total amount that's going to be financed. The current January rate is 3.625% on this loan. Again, we have a up to 40-year term. That interest rate is fixed for the life of the loan. And then in this case, we need someone else to come in and supply additional financing for that purchase. And so, again, that could be provided by a commercial lender, by Bank of North Dakota, NDRRC, the seller, and that participating lender has the ability to specify their own rate, their own term. Again, they get the first lien on the real estate, and that lender could also request a guarantee on their portion of the loan. Another way to finance real estate is 100% directly through FSA. Again, the maximum that could be borrowed here is $600,000. We've got, again, the loan term up to 40 years, fixed interest rate. Currently, our January rate is 5.625. And again, we don't have prepayment penalties. So a lot of times what we will see happen is that with a lot of the real estate purchases, 600,000 isn't going to get us very many acres with our current real estate prices across the state. So we will see a lot of times where producers will max out at FSA, get $600,000 financed with us, and then they'll look to a local lender to finance the remaining portion of that real estate purchase. And that works really good for producers. Just some changes that we had here in come through and be effective in September 2024. We actually went to an extensive training down in Houston with the Farm Service Agency for updated changes and regulations that got updated and amended. And so the biggest thing to let you all know is changes in the security requirements with Farm Service Agency. So previously, FSA, no matter what type of loan we had, required an additional amount of security to get FSA secured at 150%. We would take as much security as was available with that borrower, which has now been reduced down to 125%. And then another change with that is additional security is now not required for down payment real estate loans or anytime the applicant provides a cash down payment equal to 5% or more of the purchase price. So previously, we did require the 5% cash down payment for a beginning farmer down payment loan. And with this now, if a producer is participating in just our regular direct loan program or our joint financing or participation, and they make a 5% cash down payment equal to, like I said, 5% of the purchase price, then we will not take additional security. Another change is that we will not be taking non-real estate assets as additional security if the loan that we are making is going to have real estate serving as the primary securities. So what that is saying is that usually if we had a real estate loan and we were providing that to the producer, in order to get up to the old amount of 150% security, we would then, if the borrower had it available, take a lien on machinery and equipment for that real estate loan. So we would be cross-collateralizing that loan with the personal property or chattels and in the real estate. And so now if we are making a real estate loan and the real estate serves as the primary security, FSA is not going to be securing that loan additionally with non-real estate assets or personal property, farm vehicles, machine and equipment, etc. So that's really nice for some of our producers that and borrowers that lets them keep some of their machine and equipment free and clear that they could then use that security for other loans with other lenders. And then the last change that was made or updated is that in certain instances, FSA may not need to take a lien on the applicant's personal residence. There's some caveats to that, but that's just kind of a general statement that we may not need to be taking a lien on their home that's located in Bismarck or in town, which they're living at, and the farm headquarters are in a different location. Okay, so now here's just a table summarizing the operating loans that are available to FSA borrowers. And on the operating loan, we have maximum indebtedness at $400,000. Loan terms can go from up 1 to 7 years. Fixed interest rate, again, right now the January rate is 5.125. And again, we don't have any prepayment penalties. The biggest use that we have for our operating loan funds is to purchase livestock, whether that's breeding cows, bulls, sheep, goats. We can also use the operating loan funds to purchase, let's say, sugar beet stock, of course, to pay for annual operating expenses, seed chemical fertilizer, feed for the cows. We can use these operating funds to pay principal and interest payments on term debt as long as the debt was made for authorized real estate or operating purposes. We can use the operating funds to pay for loan closing costs, pay for borrower training if FSA requires that. In some instances, we are able to use our operating loan funds to refinance farm-related debt other than real estate. Keep that in mind. As long as the debts to be refinanced are owed to someone other than USDA, FSA, or we've had a designated or declared disaster. That is really the reason why we need the refinancing or why there may be a shortfall. And we can also use operating funds for minor real estate repairs as long as we can get that cash flow to work with those repairs at a 7-year term. FSA does also have the youth loan program. One thing to take note of is that the maximum indebtedness was increased in September to $10,000. Previously, the maximum that could be borrowed on a youth loan was only $5,000. So that program did double. Again, loan term 1 to 7 years. And in the case of a youth loan, FSA is providing those funds to young folks that are interested in farming and ranching. And we're there to help them expand their operation, start an operation, buy a couple bred heifers and get a livestock operation established, or provide funds for annual operating if they're looking at planting 80 acres of soybeans or something like that. The loan is available to youth that are aged range 10 to 20 years. And then we do need involvement from either a 4-H advisor, a VOAG instructor. We've seen county agents, extension agents serve as project supervisor. And then again, this program has a fixed interest rate. Right now, our January rate is 5.125%. Same thing with some changes for operating loans. Our additional security requirement is now down to 125%. We do not require additional security for our youth loans or our micro loans. And then again, in some cases, we would not need to take a lien on the personal residence. Okay, so here's some of the slides that I put together at the end of this that are available for our loan servicing programs. FSA has the disaster set-aside program that is available to our existing direct loan borrowers who suffered a loss or a shortfall due to the results of a natural disaster. So to be eligible for a disaster set-aside, the president, the secretary of ag, or the administrator need to make a designation that the county had a disaster. And in this case, we would need to see that the borrower doesn't have the income available to make their payments to FSA, other creditors, and to pay for their family living and farm expenses. In a disaster set aside, FSA sets aside, which means kind of puts the payment, the installment, at the tail end of the loan. In this program, the interest does accrue on the principal portion of the amount that was set aside at the regular note rate. And then at the very end of the loan, before the final due date or just before, then that set aside installment is going to be due. So ultimately, the producer or the borrower would have a double payment due at the very last payment that they had. In September, we did have a new program that was announced, which is called the Distressed Borrower Set Aside, DBSA. Hopefully, you've seen some information on that come through if you are subscribed to the FSA Gov Delivery articles. I know we issued a big monthly newsletter right away in January here, and there was an article in there about the Distressed Borrower Set Aside, DBSA. So this is a program that's available again to our existing FSA customers, borrowers who are delinquent or financially distressed. Again, they don't have the income to be able to pay all of their bills and make their loan installments to FSA. With this program, the loan needed to be outstanding prior to September 25th, 2024. That's kind of our magical date when some of these changes went into effect. With the distressed borrower set aside, we do not have to have a disaster declared. Okay, the borrower just needs to show that they are not able to make their installments to FSA and then pay other creditors. Okay, the nice thing about the distressed borrower set aside is that the interest accrues on the principal amount of the set aside at 1/8%, not the full note rate like we have with disaster set aside. So that's a major interest decrease and cost savings to the producer if they do qualify and get a DBSA, distressed borrower set aside process. And same thing here at the end of the loan, they're going to have basically a double payment due. Okay, and the last thing I wanted to talk about was our primary loan servicing options. Again, this is available to our existing FSA borrowers who are delinquent or financially distressed and can show that they are not able to make their installment. The thing with the primary loan servicing is that we need to see that the reason that they're not able to pay FSA or that they've become delinquent is due to circumstances beyond their control. So that would be, low commodity prices, a disaster, drought, too much rain, something like that. We are not going to be terming out debts for someone that took a nice trip to Mazatlan. That would certainly be within their control. So with the primary loan servicing, we at FSA have the ability to restructure the existing debt so that we can, of course, maximize the repayment ability and ultimately avoid losses to the government. And the way that we do this is through our loan program, and we look at either consolidating loans, rescheduling, operating loans, or reamortizing. We can look at interest rate reduction, deferral, or a potential write down of the principal and accumulated interest. So this program actually just tries to calculate and look at multiple different ways that we can try to term out the debt, potentially up to 15 years on a operating loan, and see if we can take that shortfall and get it moved, termed out, and help with repayment. With that, that's the end of my presentation. I apologize that I went a little long here. Jim and Amanda, if anybody has questions, we can certainly talk about those at the end. Here's my contact information. And like Amanda said, we will post our slides. So thank you so much.
Well, thank you, Lisa. I think we'll take a quick question while Jim gets up and ready. So, quick question. I think this is either for you, Lisa, or Holly. Is there a deadline for the LOC this spring?
Say that again. A deadline for
The LOC
Meaning line of credit?
I believe so.
For guaranteed loans, it's going to be whenever that borrower gets into their lender to apply and they determine whether or not they need a guarantee. I'm not sure if commercial lending institutions have some type of deadline for that application. FSA does not have a deadline for the lender to apply for a guarantee. Lisa?
And on the direct side, the only deadlines we would have would be for like the disaster set aside. We would need that application within 8 months of the date that the disaster was declared. But no, not as far as for a line of credit, if I'm understanding that question correctly.
All right. Well, perfect. I think we will table some of the other questions. And Jim, if you want to get started, yep, just click from the beginning and you should be able to be in presenter mode.
Okay. Is it working? Let's see here. Is it working now?
Double click. That's fine, Jim. Just for the sake of time, I think if you want to just go through and
Okay, let me go to try it once more here.
or if you click down on the bottom where Lisa had showed you earlier, down by the scroll button.
Okay.
Jim, it just doesn't like you.
Oh, I see that.
That's
Okay.
okay, Jim.
Okay. Anyway, we'll get going here. At Bank North Dakota, we do both beginning and established farmer program loans. Them are direct loans with the Bank of North Dakota. We also do participation loans, and that's, with some of our other programs for, beginning farmers and along the way. But anyway, beginning farmer, that real estate loan, and we do a lot of participation with FSA with this program. When I get calls or, people want to do this, lending, they come, to Bank North Dakota. I always, also ask whether they're interested in using FSA just because of the great terms FSA has and interest rates, with the budgets the way they are, especially this year and, like last year that, I think the borrower's got to try and get the best deal they can get. And that is using both programs. So anyway, to be eligible for the beginning farmer program, you have to be a North Dakota resident. The land you want to buy has to be located in North Dakota. And borrowers net worth cannot exceed 1.5 million. Principal occupation has to be farming or ranching. A lot of people have off-farm jobs, and that's fine too. I encourage that, especially with the climate, the way it is today. The ag economy. And then the other part is if they do own farmland, it can't be more than 30% of the average county farm size. And that's the same thing as FSA's requirement there. Bank of North Dakota maximum loan amount is 1.2 million. That's the lifetime cap. You can come back, more than once. There was a one point in time at Bank of North Dakota where you had one chance to use this program. That was changed, maybe 20 years ago that you can come back, you can get a second loan or a third beginning farmer loan as long as you're always, meet the eligibility requirements. As far as interest rates, right now, the rate is set at one below B&D base rate for the first 5 years with a maximum of 6%. Everyone is using the 6% option right now, pretty much, it's fixed for the first 5 years. With prime being at 7.5%, and minus 1% would be 6.5%. But so it goes to that 6% rate for the customer for the first 5 years. And then the second 5 years, it adjusts annually at whatever one below the prime rate is. And then the last 20 years of the loan, it would just float at the prime interest rate. And this is just for land purchases. Second loan is the established farmer loan program. And that is anyone that's a farmer or rancher or a resident in North Dakota can use that program. And that's for purchasing land too. And we have done restructures or refinances under this program. Maximum loan is $600,000, excuse me, $6 million. And the market, the interest rates are their market interest rates. So we do a risk rating. We've got 3 different tiers, and based on risk. And then the second part is the borrower just gets to decide whether they want to do a fixed interest rate or variable interest rate. Next loan we'll talk about is the Beginning Farmer Chattel Loan Program, and that's to assist the young farmers or ranchers with buying livestock and equipment. Eligibility there, net worth cannot exceed 1.5 million. Principal occupation has to be farming or ranching, but a lot of people have off-farm jobs. The other requirement is that if they have received government payments, they cannot exceed 15 years of receiving government payments. Lifetime cap is $750,000 under this program. That is the portion of the Bank of North Dakota and the lead bank's portion. Nice feature of this portion is the lead originators portion. There's an interest rate buy down of up to 4%. So basically what that means is, let's say your local lender is charging you a 7% interest rate would be a market rate for that loan. This fund will pick up 4% of the interest cost, so the customer is only paying 3%. So 7 minus 4 would be 3% is the borrower's rate. Bank of North Dakota's rate, we would fix that at first 5 years at 6%. Next program we'll talk about is the Family Farm Program. That can be used for, as long as they meet eligibility requirements, which is just, you have to be a farmer or rancher. Net worth cannot exceed 1.5 million. We can use this to finance the purchase or refinance of agricultural real estate debt, permanent improvements to agricultural real estate, purchase or refinance farm equipment debt, purchase or refinance livestock debt, and the other one would be restructure operating debt carryover. Under this program, Bank of North Dakota can take up to $750,000. We'll take no more than 90% of the total loan amount. Interest rate on this program is the B&D is a variable B&D base rate minus 1%, or the current base rate at 10 for up to 10 years. You could fix it. Originating bank, their rate cannot exceed B&D base rate plus 2% or be very variable or at 3.5% above the Federal Home Loan Bank advance rate. This is a program where we get, especially in times like this now where you're going to have some restructures or some tougher financing deals. This is something where Bank of North Dakota could come and participate and help reset a distressed customer. Next program is the Farm Operating Loan Program. Kind of the same eligibility requirements here. Net worth of the borrower cannot exceed 1.5 million, or the debt to asset ratio has to exceed 50%. And basically, B&D can do up to $750,000 under this program, but we will not take more than 65% of the loan. Interest rate, we're variable, one below B&D base rate, so the loan would be at 6.5% in our portion. Originating lender would be a variable B&D base rate, and would not be, may not exceed exceed B&D base rate plus 2%, so that you couldn't be higher than 8.5% in your portion. Next one, we'll do the Ag PACE program. This program we get a lot of use under this program with field tiling right now and irrigation. Can also be used for investing in a value-added processing plant, capital improvements to livestock or dairy. You can do a little bit of work there if you want to add some pens to your feedlot or something. And then and a lot of these times these get used for people that are investing in beet stock out in the valley. So basically, to be eligible here, everyone's eligible for the first 20,000 interest buy down. You can get 20,000 to buy down per biennium, up to 60,000 max over your lifetime. So that's 3 different bienniums every 2 years. After the legislature meets, we're in the current biennium we have now will end June 30th. New biennium will start July 1st, and then that runs for 2 years. There's buy down of up to 4% under this program. And then the other part of it is if you use this for field tiling, there's a $50,000 worth of buy down funds available. And if you exceed the 20,000, we can give you a 2% buy down rather than 4% buy down on, and there's a lifetime cap of 60,000 under the field tiling. For irrigation, Bank of North Dakota, can do 20,000, and then State Water Commission can come in and do 40,000 of interest buy down. So the borrower can end up with, 60,000 interest rate buy down for irrigation projects. Last program we'll talk about is the biofuels program. This one's mostly getting used right now in the dairy or the livestock industry, in North Dakota for guys that want to put up, the confinement barns or, add feedlots or so forth. So this program, there's up to 250,000 of interest buy down available. The buy down can be up to 5% of the interest rate. So, like I said, if the customer is using a 7% interest rate, 7 minus 5 would be 2% would be the rate to the customer. And that's a participation program too. And then the last thing I'll bring up is that B&D, we have been working on been listening with the customers. We've been hearing, there's a tough renewal season coming, crop prices are down, input prices are up. We are going to be having a disaster program. We're, just working on getting everything approved. It should be approved by when Industrial Commission meets here in January 28th. We expect to be able to roll it out after that. This will be a participation program like we've done other years, where you work with your lead lender, and then they sell part of the loan to Bank of North Dakota. And that this year, we'll be able to use it for these operating shortfalls, make term payments, the payments that got to get made this year and replenish some working capital. That's kind of what we're looking at doing. So with that, I will stop sharing and I will turn it over to Amanda again.
Well, thanks, Jim. We're going to do a quick poll. This information is really beneficial to Jim and Holly and everybody at the FSA office and Lisa, just to kind of help you guys with loans. So if you would, again, just mind answering some of these questions. And then we will give it just a little bit of time. There's a few questions. If you fall into that category, please just feel free to skip over them. If you're not a lender, skip straight to farm and rancher. They're just asking again kind of what the shortfall, if you have a shortfall for 2024, and where that kind of lands in that range. So again, this is totally anonymous. This is just kind of good information to give us what's going to happen coming into 2025. So with that, while we're running the poll, there was a question that came in for Lisa and Holly. Can the FSA do a bridge loan for an ag RE purchase in the situation the borrower buys land at an auction?
So the answer to that is no. And remember that if folks are looking at purchasing land through an auction, at no point can they take ownership of that land before FSA has the loan funds available to close that loan. So if it is deeded to that applicant, they are not eligible for our FSA direct real estate programs because, again, we can only use those funds to build or to buy, and we cannot use them to refinance. And we are not entertaining bridge loans at this time because we do have adequate funds. So I hope that answered that question. If whoever asked that has more specific questions, certainly reach out to me and I'd be happy to discuss that with you.
All right. Thank you, Lisa. One more question, and then I think we will call it a day. Can a borrower be considered distress for loss of cattle that is not an insurable loss?
Okay, yeah, I saw that question. And so I think if I'm understanding the question correctly, that yes, I mean, an existing borrower could be considered to be a distressed borrower if they're unable to make their FSA loan installment payments because of loss of cattle. So I'm assuming they're meaning cattle death due to, a variety of reasons. So if we had cows that died or some of the calves that died, that certainly reduce the availability of income to then be used to pay the FSA installments. So I think that yes should be eligible, but if there's a specific example or situation, Miss Lanning, that you're asking about, certainly reach out to me and we can talk about that. But I think from just that general question that should be eligible, but we can talk about it if you want to reach out to me. I'd be happy to do that.
Awesome. Well, thank you guys. I know it's 5 minutes after. Again, I want to thank Lisa and Jim and Holly for presenting today on farm loans and especially covering the 2024 update. Um, as I said, this recording will be shared along with the presentations, and I will also put the contact information for Lisa and Holly and Jim, their email addresses in the email. So look for an email from Amanda McLean at North Dakota Farmers Union coming probably later today or tomorrow. With that, if you have any questions, feel free to call them at the state office, FSA office, or your local FSA office, or the Bank of North Dakota, and ask for Jim. So thank you again, everybody, and remember to rejoin us on February 20th when we are covering ARC and PLC again with the state FSA office. With that, have a good day. Bye.
Thank you.
All right.